I didn't appreciate appreciation. I didn't value appreciation. Now I do.
What made you change that? Just seeing the appreciation and going,
Yes.
oh, wow, this is possible.
Oh, wow, this is possible. And looking as you and I have done and looking that, oh, I didn't get this house across the block, a few blocks away or across the zip code because it was a little out of reach at the time, which is now 20 years later has appreciated 2 and 3 times what it was worth.
Hey guys, welcome to the Investor's Guide of Memphis Real Estate. I'm your host, Dean Harrison. As always, I'm with Douglas Skipworth. How you doing, buddy?
Hey man, I'm doing great.
We're bringing you this podcast to give you the boots on the ground knowledge to be a successful real estate investor here in Memphis, Tennessee. Please like and subscribe to the Investor's Guide of Memphis Real Estate on your YouTube channel, Spotify, Apple Podcasts, Facebook, wherever you want to listen to us. You can watch on Facebook and YouTube. So be sure and follow us there. Show sponsored are listed on your screen below. We would not be able to do this podcast or run our own rental business without these guys. Triumph Construction, River City Title, Corland Financial, CrestCore Property Management, and then Will Griffin over at Griffin Clift, Everton, and Mashmeyer. I help buyers and sellers every day. Dean at CrestCore.com. Shoot me an email if you have any questions, buying, selling anything. Please send that over. I will get you our buyer profile link set up, and you can start receiving all the deals that we source. How you doing?
Great.
Yeah, today we're going to dive right in. Cash flow versus appreciation, and where are you at with it? Like, I get asked this a lot.
Okay.
It is one of the biggest topics and conversations I have with almost every set of investors that I work with or even partner with. Mm-hmm. So it's a huge kind of decision. It's a big thing. What do you focus on? Where are you at with it? And which do you prefer? So first thing I'm going to do is ask you, which do you prefer? As an investor with a large portfolio, when you're analyzing a property, what do you prefer? Or can I do two phases?
Sure. Oh, come on.
What'd you prefer at first?
Yeah.
And then what do you prefer now?
Yeah, that's good. Initially it was all cash flow, right? Because my discretionary income was low. Mm-hmm. So I needed cash flow. I needed the house to pay for itself. And even in that, I think I'd still say more cash flow than appreciation. I've got some appreciation plays, which I think we'll talk about, but I would say cash flow.
First thought.
I mean, it's just cash flow.
And it's simple, right? Because you want it to pay for itself.
You want it to pay for itself. Otherwise, it's like, where's your money coming from if it's not from the house?
Right.
And so that to me is like, that's not fun because it means you're putting money into
that's
something.
Right. So it's got to pay for itself. And you know, a lot of people, I can't imagine you're buying a rental property for the $300 a month in cash flow, looking to pay your car insurance with it, right? That's not why you go buy a rental property. So you buy a rental property, in my mind, to pay for itself and to appreciate.
Yes.
I need both of those.
Correct.
You know, and my thought to that was at first, just like you, my very first one, I thought, I'm not going to lose any money every month. This has got to be more. It's got to be. Way less focus on how much is this going to be worth later or now.
Right.
Hell, I didn't even care what it was worth right now. Right. You do, but you don't. I need to look at the paper and see that it pays for itself.
See that it pays for itself.
It's like buying your first car and they get you in the car dealership and it's like they want you to pay, never tell them how much you can pay monthly, right? Like, so we're worried about monthly payments and we're worried it's trying to stick to that and have it pay for itself. First thought.
Yes.
Simple, easy. I look for both. And I'll tell you why. It gives me leverage and it gives me options that buying one with 20% down doesn't. And I don't like the 20% down method because that money's gone.
Yep. It's just tied up.
It's tied up. It's gone. I prefer to find some forced equity in it.
Yep.
Some appreciation that I know is going to come over the years. Value add is a term a lot of people use
for sure.
or what have you. But the first and foremost is, I guess it's got to pay for itself. And shifting over into, is it going to be worth more later? I think you've got to factor both in. I don't know that I can weigh both one on the other now. This far down the road, I can't. Meaning I can't decide which side of this is going to be more valuable to me or not right now.
Yes.
So fast forward to where I only cared about the cash flow. Only. Just like you. That was your first response.
First response was just the monthly payment And to get to what you said, when I initially started, I didn't have discretionary income.
Yeah.
I couldn't put money in.
Yeah.
So I just had to find houses that the rent minus all of the expenses would cover the note.
That's right.
And I to your point, I didn't necessarily care about bringing home money to pay for my phone bill or my light bill or anything like that. I just wanted the money in the property to pay for the note, to pay off the bank, to pay the mortgage.
Yeah.
And I didn't even bake in appreciation. I just thought, man, if I can get this house and I can get it to pay for itself over time without having to put money in, then someday it's going to be worth what I paid for it.
Right. That's right. And right. And I have that same, all right, so let's go into individuals.
Yeah.
All right. As an individual, some people say, why would you prefer that appreciation over the cash flow? And it's an individual thing, right? And I'm trying to follow along my notes. We're bouncing all over the place, but I'm following along my notes here. So I don't necessarily, I sell houses, so I make your discretionary income, and I can afford not to have this pay me really anything. So I don't necessarily
the rental house you're purchasing.
Yeah,
you're not looking for that cash flow.
I haven't paid myself a dime
out of it
ever.
Right.
2015, I bought my first one. You know how many checks I've written to Dean Harris? Not a single one.
Right.
None. Written a lot of checks, just none to myself.
Yes.
I'm on 15-year note payoffs.
Okay.
And that's some of the reasons why it's very, very thin. But I have my job where I earn income that I can take care of my family and my life and everything that's going over here, so I don't have to have this pay me anything. Right. I even put money in every year, Douglas. I mean, of
your own as an investment.
Yeah, it's an investment. I mean,
like you would be putting into a stock market, like you would be putting into any other asset or any other business, any other investment.
And my appreciation and my growth is so much bigger here. That's a whole separate podcast. Maybe that is another one. But yes, I want the thing to appreciate, and it gives me options, right? I don't have to pay for that. I'm a 1099. I don't have a 401k. I don't have, all of these funds that people with a W-9 have.
Yeah.
So I have to have, it can't just cash flow for me. This is, I'm looking at this and going, man, I've got about 45% equity in my entire portfolio. So so I'm buying cash flow a little bit, but I'm really not.
Right.
I'm really buying appreciation. Yeah. Almost full time at this point.
Yeah. And I think so that was my initial come to it. Like I said, with cash flow's got to pay for itself. Don't plan for appreciation. And I think I've said before, but that was the biggest, one of the biggest ahas or gotchas that I did not realize that home price appreciation averages between 3 to 5% nationwide over the years. And at the time I was starting, Memphis was pretty flat. So I just wasn't planning on it. And because of that, which is great, I got a ton of appreciation over the past decade that I had not planned for, which is a blessing. However, if I had really thought, all right, I'm going to hold these over 20 years, and maybe it's going to be lumpy, maybe some years it's going to be 0, and some years it's going to be 7%, but over time it's going to average 3%, then I could have planned for that appreciation, and I could have paid a little more because I would have been making up for it as rents increased and as the home value increased, putting some of that excess cash flow that is building up in the portfolio, like you're talking about. Else, I didn't.
How could you avoid that?
I didn't appreciate appreciation. I didn't value appreciation, and now I do. And so, I've gone back and I'm like, I understand how this works.
And how could you avoid that? What made you change that? Just seeing the appreciation and going, oh, wow, this is possible.
Oh, wow, this is possible. And looking, as you and I have done, and looking that, I didn't get this house across the block, a few blocks away or across the zip code because it was a little out of reach at the time, which is now 20 years later has appreciated 2 and 3 times what it was worth.
Yeah, so I'm trying to think to myself, how can you? I don't know that's.
And the rents have maybe increased 50%, but the value of the home has increased, 200 or 300%. more than doubled, maybe tripled in value.
And I don't think we've got that kind of room left to go, but I think
Today,
we've got more room.
Yeah.
And then today is true. Because I mean,
what about tomorrow?
20 years ago, you would have never thought to yourself these would have tripled up.
No, but if you work the math on the 3.5%, it will triple in value over that 20 years.
If you listen to the total optimistic person on the values, we're going a little off schedule here, but on the values, they'll tell us that our homes are going to double and triple again because of the demand is going to keep increasing and we can't keep up with the build. It's not going to happen this year, next year, the next year.
Right.
But in 15 years from now, all of our $150,000 houses, could they be worth 300? They very well could because of our lack of inventory.
Yes. Yeah. And so to your point is like nowadays I do have some, and I guess one other thing I say is I would separate them and be very intentional.
Yeah.
And be like, this is a cash flow house. This is an appreciation house. Kind of like you said, like if I'm buying it for appreciation and knowing I might have to put in a little extra every month.
Yeah.
Like here's my note.
Yeah.
Here's what my rent is. Maybe the rent covers the note just barely. So I'm like, I'm pretty good if everything's going great. But if I have a vacancy or if I have a big expense, I know I might have to put something in. But man, I've got so much upside, or I bought it right. I got a deal and the appreciation is there. There's some forced equity already,
right?
Or there's appreciation that's planned in certain places. You and I have some in some other, either in parts of town that are higher appreciation, or in other markets that are higher appreciating.
There's where you might be going. Most investors are a little more short-sighted. Is kind of a hard word. Is a harsh word. Most investors look for cash flow first. And only.
Yeah.
Because it's like, hey, we need this to live, or this has got to pay for something.
It's got to pay. I'm borrowing money and I got to pay for it.
So
how many of your investors buy all of their property outright in cash just for the cash flow? I've got $2 million, Dean. I need to buy, 10 houses and I'm going to live off of that monthly income.
Very few.
Yeah. I mean, I can count on the hand.
Very few
one or
come
two
to
hands
me and go, hey, I got
us in that scenario.
Very few.
Over the decades. Mm-hmm.
Most
people are borrowing money. And so they have to have
the cash flow to cover that. So that's what and here's my caution to that. This is why I bring that up. Most people do want that first and desire that first. And that makes total sense. It's got to pay for itself. A lot of times you look for that immediate cash flow, which means it's an occupied property. And we've talked about this before. Occupied properties are... It's like kissing your sister.
Yeah.
You know what I mean?
It's a kiss.
It's a kiss, but damn, it's your sister. So you get that cash flow coming in right away, and it comes in. But here's you don't think about anything else, and that's where I caution investors. This is what you got: somebody that's living in the home and they're paying rent. And the worst thing that could ever happen is somebody comes up to me and they think they're telling me the greatest thing ever. Hey, they've been here for 8 years, paying rent every month for 8 years. We love them. That means there's not been one thing done to that house in 8 years.
Wait till they move.
That's what that means. So wait till they move out and you got to turn. And the rent rate goes down, or do you have to do so much rehab to keep it up?
Yeah.
Okay. And if you don't think that happens, buy a bunch of them. And now it happened to me.
Oh,
I bought my first 6 or 7 this way. Used hard money, refinanced them with the bank, had them occupied. What happened? Tell me what happened.
Tenant moves out and you have to do a repair on all the deferred maintenance you hadn't done. And you can't find, you got to pay for that out of pocket. And like, where's that 20 grand come from?
Or the house sits there. You don't have any options. You don't have a choice. So I burned myself so bad on this. And at the time, did not have the discretionary income that I have now.
Right.
I mean, it just couldn't. It was way bigger of a deal. I thought to myself, I'm never buying it like it again. And honestly, I don't think I have.
Yeah.
I think I've buried everything else since then. So that's my point. You come into unexpected hurdles with rehabbing condition when you buy for immediate cash flow. Now, if you think cash flow like after I burn it and what it's going to rent for, fine. Then you can, as long as you're patient, you get down the road, cash flow is the most important thing, then cool. But if you buy immediately on day 1 to close and need cash flow on day 31 after you close, I'm going to caution you on that. In our market, it could be different in some other markets, but in our market, I just think my notes were beware of buying occupied properties. They're not offering proper value or decrease in value. Talk on occupied, properties when they go vacant.
You had a client.
That was my note.
You experienced that, and then I think you had a client who had a similar experience recently.
Yeah.
On those.
Yeah,
so,
by a lot. And it just happens. It's like, and now the client has two different things.
Yes.
And they're going to be able to compare and contrast. So, I'm excited for that for them because it's a learning lesson. And like, hey, where do you want to put lean? Is this a business or is this just a cash flow? And that's what I look at long term. That's why the appreciation factor for me is there so much, because this is long term for me.
Yes.
And I want something that's going to be worth way more later than what it is now. Who wouldn't? Why wouldn't you? So anyway, appreciation offers flexibility, refi in a downtime. That's happened.
Yeah.
You can refinance and extend out further dates. What else do I have here? Sell the property if you needed, borrowing power, leveraging power. It just gives you so many options if you have that equity and you've got that appreciation.
Yeah, I think I heard you say you have 45% equity across your portfolio,
right,
which gives you options.
Yeah.
Gives you all kinds of options. You can sell that.
Yeah.
You could probably get, maybe you could get a second position equity line on some of that.
Could.
Or you could refinance a portion of those at 80+% and have a bunch of free and clear ones.
Yeah.
So there are all kinds of options.
All kinds of options. And
those are just a couple off the top of the head.
But that's what you get with the equity play, the BRRRR strategy, or whatever it may be, to create equity or appreciation as the years go along. So no, I think it's great. Cash flow, number 5, let's see where we at here. Number 5, cash flow offers. Cash flow is not a ton of flexibility if you're only on cash. If you're just looking at the cash flow, you just don't have much flexibility. If you bought it at the right price and you put 20% down at the market value and you put 20% down and you've got your cash flow coming in and that's all you were concerned about, and it's $400, $500 extra a month. That's it.
That's it. And rents will go up, but they're not going to go up extraordinarily fast because they're a function of incomes. Yeah. Incomes aren't going up fast right now.
Take you 4 or 5 years to get that cash back. It's just a little bit different play.
And expenses are going up. Maintenance, insurance,
all of that.
Taxes.
Yeah. So
yes, cash flow doesn't give you that flexibility, which you're saying, versus the appreciation in the equity build.
So overall, I think if you can pay for the property and buy something for less than what it's worth, and then buy in an area where you're seeing some history of appreciation, is the way to go. I understand it's got to pay for itself. Nobody's going to buy negative flowing property. I get it. Mm-hmm. Understand that. But consider the bigger picture.
Yeah.
Even if you're an individual and you're not going to buy 100, you're buying 5 or 6, 7, 8, 9, 10, whatever it may be. I would continue to target both. Have it pay for itself, but do not be blind to the appreciation factor. What else you got here?
No, I'm just thinking on an example. I had one that it's an appreciation play, and I feel like I got a good deal on the purchase, and so I was able to finance the whole purchase price.
Right.
Yeah. So no money down.
Yeah.
No money down, but I have to put in a little bit every month. And it's appreciation. And so in my little example, the way I did it at a 3.5% home price appreciation, I think I've got a conservative 10% return, conservative cash on cash return, because I have to put a little bit a month in, but that's on a conservative 3%. And I think this market is better. This location is better for that. So I'm excited. So I kind of, in my mind, I'm putting money in, but I'm like, okay, this is getting me, this is like I'm putting in the stock market at 10% return. Yeah. And it's pretty good. Now it might be a little lumpy again. It might not be 10% every year, but I feel good that if I have to put a little money in every month after the rent is paid and the mortgage to pay that mortgage, I like this situation because it's an appreciation play.
Speaking of examples, I'm about to run close to 75% of my portfolio in a refi.
Sweet.
Yeah. And it's easy. And it's going to go, because I've positioned myself from the very beginning with these 15-year notes, and the appreciation on top of me knocking down that principal for so long has given me this almost 50% spread in a lot of homes. I mean, it's not a small portfolio. I mean,
so would that give you a little personal, but will it give you, are you going to take that principal balance and spread it out over a longer amortization at a lower rate so that you have more cash flow? Or are you going to keep it on a shorter and kind of like we talked, leverage this side up and pay these off?
I'm going to go longer and clear up some cash flow because my appreciation is still going to be there.
You said you have cinched the belt pretty tight because you've been trying to pay them off in 15 years. So it's going to give you some breathing room so you don't have to pay.
So not only will it pay me, it's a twofold. Not only is it now going to pay me, but then I stopped the leak.
Yeah.
So it's actually twofold. I'm hanging on to some and getting a lot more.
Man, that's like when you walk into an ice cream place and they give you a scoop of vanilla and a scoop of chocolate. Yeah. Like you get the 2 scoops on there.
That's right. Yeah.
That's you, man.
I've got it both ways.
So double dip.
That's awesome. Anyone can position themselves like that if you buy the right way. And if you only look at cash flow and that's kind of it, you're going to get stuck.
Man, that's a great example.
Yeah. Yeah. You
call.
go with appreciation, you get some flexibility.
Yeah.
So I thought this was relevant. I get a lot of questions about the cash flow and appreciation and what I target and what I go for. It's changed over the years is the honest answer. Yeah. But right now, right this second, I don't care about $200 a month. I want it to pay for itself and I want it to be worth a lot more later. Okay. Way more concerned with that now. So great stuff. Good podcast, guys. If you have any questions, Dean at CrestCore.com. We'll see you next time.